Welcome to The Explainer. Today, we're going to pull back the curtain on this invisible machine that runs our whole financial world. We're talking about the cycle of debt and credit.
So, have you ever wondered why the economy feels like such a roller coaster? You know that feeling, right? One minute, everything's booming, there's confidence, growth, and the next, it's all anxiety and contraction. But what if I told you that this ride, it's not random at all? It actually follows a pretty predictable pattern, and today we're going to break down exactly how it works.
All right, let's dive right in. Look, to understand this huge complex machine we call the economy, we've actually got to start small, super small, with its most basic part, just a single transaction, one that's built on credit.
And this quote from Ray Dalio, man, it just nails it. It's so simple, but it's our whole starting point. See, credit isn't just you borrowing money. No, it's the engine. It's the core thing that moves money from one person's pocket to another's, and that creates a huge ripple effect.
I mean, just think about it for a second. Let's say you take out a big mortgage, right? 300 grand. That money doesn't just vanish or sit in your account. No way. The person selling the house gets paid. Their real estate agent, they get a cut. The contractors you hire to fix the place up, they get paid too. Suddenly, your spending, which was only possible because of credit, becomes the actual income for a whole bunch of other people. It's a chain reaction.
Okay, but here's the part that kind of blows your mind. This is something most of us just don't realize about banks. They aren't just lending out money that's sitting in a vault. That's not how it works. Through this system, when a bank gives you a loan, it is literally creating new money. Poof, out of thin air. Money that didn't exist a second ago. And then that new money gets spent, deposited, and loaned out again, and that's how money just multiplies across the whole system.
So, okay, we've seen how one loan works. But what happens when you zoom out? What happens when millions of people are all doing this at the same time? Well, all that individual borrowing and spending, it starts to add up, and it creates this rhythm, a surprisingly predictable one. And we call that the short-term debt cycle.
And this cycle right here, this is the roller coaster. This is what we feel every single day. It usually plays out over, say, 5 to 8 years. And what's driving it? It's us. It's our collective human nature, really. We borrow to spend more than we make, which creates a big boom. But then, eventually, we have to pay that debt back. So we're forced to spend less, and that's what creates the bust.
So, what does it actually feel like to ride this thing? To live through the booms and then the busts? Well, as you can imagine, it's like living in two totally different worlds depending on where we are in the cycle.
Yeah, they're polar opposites. The boom, that's the party. Everybody's happy, asset prices are shooting up, confidence is through the roof, and getting a loan is easy. But the bust? Well, that's the hangover, right? The party's over. Confidence just evaporates. Prices start falling, and all of a sudden, credit gets super tight, and the whole system starts to seize up.
Okay, so you've got this wild roller coaster. To stop it from literally flying off the tracks, you need someone managing the controls, right? Well, that's where institutions like the Federal Reserve come in. Think of them as the ride operators. And their main tool, their big lever, is the interest rate, which is really just the price you pay to borrow money. And it's all a very deliberate balancing act. It's pretty straightforward, actually. When the economy's dragging, they lower rates. That makes borrowing cheaper, which gets people to spend more. But when things get a little too crazy, too hot, and prices are rising too fast, yep, that's inflation. They hike up the rates to cool everything down. They're constantly trying to just smooth out the ride for all of us. But what happens when these little cycles keep happening one after another for decades? Well, each time, a little more debt gets left behind. And eventually, you have a mountain of debt. A mountain so big the whole system just can't handle it anymore. It reaches a breaking point. And the 2008 financial crisis, that is the perfect and terrifying case study of exactly that.
If you look at how it all went down, it followed a pretty clear path. First, you had years of super cheap credit, which fueled this massive housing boom. But a lot of it was built on really risky subprime mortgages, basically loans to people who probably couldn't afford them. So when the Fed finally did its job and raised rates to cool things off, homeowners started defaulting left and right. That led to huge institutions like Lehman Brothers just collapsing, and it was like the entire world's credit system froze solid overnight.
So, what was the secret ingredient that made 2008 so incredibly destructive? What turned a problem into a full-blown catastrophe? The answer, in a single word, is leverage. It's a simple concept, just using borrowed money to invest. But man, it is a powerful, powerful double-edged sword. Let me show you how it works on the way up, because it feels amazing. Let's say you buy a property. You put down a fraction of the price and borrow the rest. If that property's value goes up by just 10%, guess what? Your return isn't 10%. Because you used borrowed money, your return on your own cash is a whopping 50%. Leverage makes your gains absolutely massive.
But, and this is a huge but, here comes the brutal flip side. If that same property drops in value by 10%, you don't just lose 10%, you lose 50% of your own money. Just like that. And in 2008, when you had massive leverage across the whole system, even small dips in house prices were enough to completely wipe out investors and even entire banks.
Okay, so after all that, knowing that these cycles are just part of the deal, that they're going to happen, it all boils down to the most important question, right? How do you prepare for them? How can you set up your own financial life so that you can handle not just the good times, but the bad times too?
Look, the secret isn't trying to be a genius who can predict the future. Nobody can do that consistently. It's not about timing the market perfectly. Instead, it's about building a strong, robust personal system. It means being smart with debt, not taking on too much. It means diversifying, not putting all your eggs in one basket. It means having some cash ready for when things go wrong or for when great opportunities pop up. And maybe the most important thing, just accepting that these cycles are normal. They are part of the machine. Don't let them spook you.
And that really leaves us with one last big critical question. The tools we used to fix the 2008 crisis, printing trillions of dollars, holding interest rates near zero for more than a decade, well, that may have solved the problem back then, but it also created a whole new set of challenges. It fueled the huge asset bubbles and the inflation we're dealing with right now. So understanding how this machine works is absolutely the first step. But we have to remember, the machine is always changing, and figuring out how to be ready for whatever comes next, well, that's the real challenge, isn't it?